Welcome, tech enthusiasts, to your Monday fix on the Tech Stocks Daily podcast. Get ready for a thrilling ride through today's high-stakes financial landscape. We'll kick off with Snowflake as it catches an AI-fueled updraft, lifting its stock sky high thanks to a boost from Wedbush's expert. Then we'll dive into Meta's robust financial positioning amid a game-changing proposal down under, aiming to control social media access. Next, we'll explore the attractive allure and fiscal maturity of Leidos, a hidden gem tantalizing growth and value investors alike. Finally, hold on tight as we navigate MicroStrategy's dizzying Bitcoin obsession, fueled by bold debt moves and even bolder stock valuations. Whether you're here for AI magic, social media intrigue, or crypto roller coasters, your daily dose of tech news and stock savvy lands right now. Hey tech enthusiasts, got some juicy details today about Snowflake, a company that's making splashy headlines thanks to some serious AI buzz. You might want to buckle up because Snowflake stock got quite the lift this morning, hopping up by a robust 4%. But why? What's spurring this celebration in the data cloud world? Let's dive in. First off, let's talk AI. It seems like these two little letters might as well stand for awesomely irresistible, because that's what they've been for Snowflake investors. The spark that sent Snowflake soaring was a glowing endorsement from Wedbush Securities analyst Daniel Ives. Ives painted a vivid picture of AI as the next frontier of software transformation and bestowed upon Snowflake the gift of an upgraded rating, push it to outperform with a new price target of $190 per share. That means Snowflake could potentially climb even higher than today's price. We all know Snowflake has been cozying up to AI for a while now. Initially branding itself as the data cloud company, it hasn't been shy about tech pivots. The company's recent rebranding to the AI Data Cloud Company isn't just a jazzy marketing spin. It reflects its strategic direction towards AI-powered data solutions. But Ives isn't all talk. Snowflake's recent financial outcomes back up the hype. Their fiscal third-quarter earnings report showed revenue climbing to $942 million, beating analyst forecasts that suggested a ceiling of $897 million. What's even cooler? The company managed to shoot its product revenue up by 29%. Introduce Snowflake Cortex into this narrative, its AI feature family that's gaining traction faster than a cat meme on social media. And then there's the future money sitting in Snowflake's back pocket. The company's remaining performance obligations, a nifty financial term that basically means the cash they already have commitments for but haven't recognized as income yet, jumped to a whopping cool $5.7 billion. This is a hike of 55% year over year, meaning customers are locking into Snowflake's long-term vision. So why is this all happening now? It's clear enterprises are gearing up to integrate generative AI at scale, with the crystal ball suggesting 2025 will see full-force adoption. As companies pivot to next-gen tech, billions are expected to be spent, and Snowflake is appearing on the fast lane to capitalize. To wrap up, the road to AI glory seems well paved for Snowflake as they chart a course through the great AI revolution. Whether they're on a data cloud 9 or climbing a fiscal Everest, the stars appear to be shining brightly on them. For today, and seemingly, best, easygoing skepticism is fair, but being in the AI orbit is never a bad look. Keep an eye on your data, the Snowflake is yet to melt. Hey tech enthusiasts, let's dive into the buzzing headlines today where Meta Platforms Inc. made a significant splash. First up, we have an insightful analysis into Meta's financial position compared to its peers in the interactive media and services industry. Meta's been at the forefront of the social media world, and why not? With nearly 4 billion monthly active users flaunting on apps like Facebook, Instagram, Messenger, and WhatsApp, they're practically dominating the virtual party scene. This family of apps doesn't just keep Granny entertained with cat videos, it's a digital powerhouse for communication and advertising. And speaking of advertising, that's where Meta really cashes in, leveraging its vast user data to serve up ads like the world's most personalized ad jukebox. But let's talk numbers. Compared to its industry amigos, Meta shows a promising potential with a lower than average price-to-earnings ratio, suggesting there's more room for growth. On the flip side, its price-to-book and price-to-sales ratios are way above the industry average, which some might call the fancy way of saying overvalued. Despite these, Meta's hitting home runs in terms of profitability, efficiency, and growth, boasting a return on equity that's significantly above average, along with blockbuster EBITDA and revenue stats. The debt-to-equity ratio plays the superhero card here, as Meta has a lower debt dependency than its peers, arguably offering a more stable financial posture. So investors, take note. On the balance sheet, Meta might just be that one friend who's both reliable and ambitious, always aiming for the next big thing. And on to the second headline, a dramatic twist, courtesy of Australia. Prime Minister Anthony Albanese announced a sweeping plan that could impact global social media practices, banning accounts for the under-16 crowd. This involves enforcing a strict age verification process involving features like biometric ID or government ID. Platforms like Meta's Facebook and Instagram need to shred any collected personal data ASP after age checking, or risk staring a $32 million fine right in the wallet. Social media companies are expected to turn into data ninjas, carefully protecting user privacy, the specifics of which have sparked debates. Not even tech magnate Elon Musk is thrilled, as some suggest this could tighten internet browsing freedom in Australia. The government, however, seems determined to pass the new law. So whether it's outperforming its financial league or potentially restructuring social media rules down under, Meta certainly knows how to stay in the news bonanza. Leidos, everyone's favorite heavy hitter in the defense, aviation, information technology, and biomedical research industries, is making waves today with a hefty helping of investment allure. You know, the kind of allure that makes growth investors drool and spreadsheets spontaneously combust. The buzz today is all about why Leidos is catching the eye of growth investors and sharply outperforming its competitors in terms of value. Leidos has been given a strong nod by the folks over at Zacks, famous for their knack in the stock reporting scene. Currently sitting pretty with a Zacks rank of number 1, Leidos is looking like a particularly savory option if you're in the market for a robust growth stock. Why, you might ask? Let's dissect the juicy news nugget. First off, it's Leidos' impressive earnings per share growth that has everyone talking. We're looking at a projected whopping 35.5% increase this year, handily skating past the industry average of 9.5%. EPS growth often acts as a magnifying glass for a company's categorical earnings and overall business potential, and Leidos is clearly a case study in exceeding expectations. But wait, there's more. The moolah flow in and out of Leidos is making some serious noise. Cash flow metrics reveal a stunning year-over-year growth of 55.5%, compared to the industry average of 12.7%. More cash means more opportunity for exciting projects without the messy entanglements of outside funding. It's like having your own lemonade stand, and suddenly your cellar is stacked with limitless cartons of lemon juice. Then there's the bonus round for value investors looking for the best bang for their buck. A quick spar between Leidos and Howmet Aerospace, both heavyweights in the aerospace defense sector, reveals that Leidos has the upper hand if you're hunting for undervalued gems. With a forward PE ratio of 16.74 versus Howmet's 44.63, and a PEG ratio of 1.13 against Howmet's 1.60, Leidos is really flaunting its fiscal finesse and maturity. Zacks has given Leidos a value grade of B, indicating it's grazing on unusually green grass in today's economy. And if you love sorting through balance sheets, first props to you. We see that Leidos' price-to-book ratio comes in at a tidy 4.73, compared to Howmet's 10.87. The message is simple. Whether you're a growth enthusiast or a value investor, Leidos is turning all the right heads. So Leidos in today's spotlight isn't just a coincidence. It's a calculated move powered by mind-boggling earnings growth, surplus cash flow, and investment metrics that put the fiscal in thrill seeker. If you've been on the lookout for your next big investment play, keep your binoculars pointed at Leidos. All right, tech enthusiasts, buckle up because we're diving deep into MicroStrategy's wild week. Why was MicroStrategy splashed all over your news feeds today? Let's unravel this crypto roller coaster. First off, famed investment advisor Gary Black tossed a curveball by suggesting MicroStrategy shares are seriously overpriced. How overpriced, you ask? Well, Black crunched some numbers and came up with the juicy prediction that the shares should be valued around $105, which is a whopping 75% drop from where they're currently shimmying at around $421.88. His reasoning? He argues it's bonkers to have a stock market value of $106 billion when MicroStrategy's total Bitcoin holdings and software business contribute to only a $27 billion enterprise value. It's the crypto-crazed math that just might make Pythagoras roll in his grave. Now, you might be wondering why investors aren't hitting the panic button left and right yet. Part of it is the frenzy over a $3 billion convertible note offering at, wait for it, a 0% interest rate. Cue the collective gasps. That's right, no annual interest due in 2029, which is like finding a unicorn munching on a four-leaf clover in the tech finance world. This means MicroStrategy could keep buying more Bitcoin, and come 2029, they either pay back the debt or happily convert it into stock, provided the shares hit $672.40. Given they're lounging at $421.88, it's not exactly pocket change they'll need. So what's the deal here? Once again, we're reminded of CEO Michael Saylor's bold gambit to pivot the company from delivering software solutions to becoming a Bitcoin gigantor, with a balance sheet decked out with 279,420 Bitcoins. This risky strategy is like the tech equivalent of strapping a rocket to a shopping cart. Probably not advisable at first glance, but undeniably exciting to watch. Microsoft's been doing its gleeful Bitcoin dance, up 550.7% year to date, mainly hitching a ride on Bitcoin's 10% sprint this week alone. But smart folks and number crunchers advise caution. Going all in on overpriced shares for a risky slice of pie when you can just afford the whole bakery is food for thought. What do you think? Are you team, I'm buying that stock for sure? Or do you agree with the cautious nod from experts mumbling, no thanks, I'd rather buy Bitcoin? Or are you among the crowd just chilling with neither and simply watching from the sidelines, sipping on a Better Call Sailor iced latte? Let me know in the comments below. As always, your insights, opinions, and crypto fortune-telling skills make this tech ride all the more fascinating. Throw in those thoughts, and let's discuss just how high this crypto balloon can fly, and if it'll float back safely or suddenly go pop. All right, let's throw some light on Snowflake today. With all that's happening in the world of data clouds and those magic letters AI dancing in our minds, Snowflake presents a tantalizing opportunity for the investor inside us all. Today's stock jumped like it had springs in its feet, up by 4%, thanks to some shrewd cheerleading from Wedbush's Daniel Ives, who gave it an upgraded, outperform rating with eyes on a $190 price target. So what's the verdict? Hold. If I were sporting some snow stocks in my portfolio, my play would be to hold them, at least in the short-term roller coaster ride. Listen up, this company is rebranding as the AI Data Cloud Company and riding the AI hype wave, a hefty rocket to propel their growth forward. Financially, they're not just blowing smoke. Snowflake reports more than positive fiscal growth, $942 million in quarterly revenue, and exceptionally substantial increases in future commitments, up 55% in remaining performance obligations. That means businesses are pegging their bets on Snowflake to help pull in the harvest from the AI frontier. However, let's chill a bit on mass purchasing just yet. Despite the euphoric AI vibes, buying now might be jumping the gun only because future prospects still hinge on how robustly AI advancements and adoptions gain traction. Remember, the market's rapid ebbs and flows are like an unpredictable river stream, always due for a speed change. That being said, Snowflake's financial chops suggest redemption potential, but we're not basing our entire financial vibe on one pretty presentation slide, right? Everyone's portfolio puzzle piece is uniquely shaped. Ultimately, folks, part of being a savvy investor is doing your homework. Decipher the headlines, sift through all available data, compare, contrast, and then compare some more to design the strategy that fits your personal vault of goals and risk appetite. As sparkly as Snowflake feels today, don't forget your analytical snow boots when trekking through financial terrains. Seek out tailored advice, absorb insights, and yes, venture with occasional optimism, but armed with informed skepticism in your arsenal. It's been quite the whirlwind in the tech stock universe today. Snowflake is surfing the AI wave with soaring stock prices and a promising future, while Meta keeps its performance robust amidst potential changes in social media's playbook. Meanwhile, Leidos captures the spotlight with its immense growth and value play that's making waves in the defense sector. And let's not forget the roller coaster ride that is MicroStrategy's Bitcoin-centric strategy, stirring debates around overvaluation and bold financial gambits. Remember, in the high-flying world of tech, staying informed is your best tool. So, if you enjoyed this market sprint and want to keep up with all the daily innovations, mysteries, and shakeups, don't forget to hit those like and subscribe buttons. Share this video with your friends who need to catch up on the latest market madness, and be sure to tune back in tomorrow for another round of tech news magic. Until then, keep those market radars on full alert.